Hello and welcome. You are watching News9. I am Suyash Maheshwari and we are on the sidelines of What India Thinks Today Summit organized by the TV9 Group. And with me is a very special guest, Mr. Andrew Holland. He's a market veteran of over 40 years, has been tracking Indian markets for nearly 30 years now. Thank you for joining us here on News9.
My pleasure,
Andrew.
Thank you.
And I want to begin by asking, you are here to speak on betting on India. You are part of that discussion. What makes you and what made you bet on India?
It's a long story, but you know, it's before I came to India, I came over for a holiday, but this is back in 92, 93. And I saw all these papers outside a petrol station. I think that's a lot of newspapers. But when I walked over, it was actually IPO application forms. I thought, oh, something's happening in India. And 5 years later, I was given the opportunity with Merrill Lynch to come to India, and I've been here since.
All right, and you know, certainly our markets have delivered phenomenal returns. In fact, if you look at Nifty, it's on an 8-year winning run. No other market has performed that way. Do you expect 2024 to, extend that winning streak?
I do. I think earnings will grow by at least 15% this year. And I think markets will probably rise in that kind of range of around 15%. Now the question is, will we see before the elections the market taking all of that in? So far year to date we're up about 2%. So it's not racing ahead in terms of baking in all the expectations. But we still have a few months to go before May. And that would be my only slight concern, is that we bake in everything before the elections, and then there's really, the market has nowhere to go afterwards.
And any other factor that you could, that you think could potentially derail this momentum that we have seen?
I mean, obviously it's got to be global or geopolitical, because at the moment, our GDP growth is very strong, corporate earnings are very strong, and therefore, you can only see that going forward, interest rates will fall like they will globally. So really be some global factor, which I think the market's probably even not is discounting, or is still yet to kind of occur. So there's some headwinds out there. Markets ignoring, whether it's Israel, whether it's Ukraine and Russia, or any other factors at the moment.
All right, and of course, when we talk about India, we also talk about other emerging markets as well, right? And India, of course, because we have delivered phenomenal returns, India is slightly expensive. In fact, it's twice as much expensive as China at the current juncture. We are currently trading at a forward PE of about 20x, whereas China is available at about 9x. Is it a classic case of you get what you pay for, or is China available at a discount here?
No, China is at a huge discount to its previous valuations. Now the concern for investors is, will it be able to turn around? It's got a big property problem. The government there and the authorities have not really kind of addressed that and got consumer sentiment back positive towards the property market. So there's a lot of headwinds for China at the moment, and therefore investors have gone from this, we love China, to now we don't want to talk about China. And a lot of investors, when you go and meet them, previously it used to be India and China, or China and India when you talked, and it'd be about valuations. Now China is not even on the table. It's really how expensive India is or not, and should we be buying into it. So that's a big shift in terms of investor sentiment from China towards India. But you can't write China off. I mean, it's a huge economy. So if they do kind of stabilize the market, get confidence back, then I think you'll see flows come back to emerging markets, and particularly aimed towards China. In fact, in the last month, I think you saw $21 billion go into China's equity markets from foreign investors.
And do you think India at 20 PE is currently expensive? Because, we have been talking about how India has delivered phenomenal set of returns, but foreign institutional investors, they have been rather absent for the last 6 months, sir.
Yeah, so I think in terms of foreign investors, I think the part of their problem has been that they've been getting redemptions in their emerging market funds or whatever funds they're running. And therefore, you're saying, I own some China, I own some India, China's cheap, therefore I'm going to have to take some profits away from a country I love in terms of investments, is India, because valuations and the performance has been so strong. Now, in terms of going forward, if we're correct in our earnings forecast, then the second half of the year you might see an acceleration in earnings, which again will kind of bring that PE down as the multiplier effect of all the infrastructure expenditure, and with private capex now starting to pick up quite sharply, that will again aid the kind of different industries which supply infrastructure industries.
And I'll keep it with the global markets for now. And in the emerging market pack, how do you and where do you rank India, and what other countries investors should consider if they are plan to invest in emerging market basket?
See, India offers that diversity in terms of not only market cap, but the different types of industries. So there's only really China which is probably competing in that respect. And therefore, if you look at other countries within Asia, say like Vietnam, it's still a small market cap country in terms of the companies you can buy. So then you say, okay, if the world's going to see a downfall in terms of recession, interest rates are going to fall. When it picks up, it's going to be the exporting countries. It's going to be your Koreas, your Taiwans, your Chinas, your Japans, which people will look to in terms of valuations and say, this is cheaper than India at the moment. But of course, when those flows come to emerging markets, India's weightage is around 16%, so we will get some of that.
All right, and over the last year, the PSU sector in India, I mean, of course, it's very vast, and there are multitude of businesses in the PSU sector, but they have picked up, and the rally has been, certainly a stellar one at that. A lot of these stocks, they have turned multi-baggers. What's your opinion of on PSU banks or PSU stocks at large at this point in time? Are they looking overvalued to you?
Well, in certain sectors, I mean, they are. It's been a great rally, and it's been based on a lot in terms of the governance has changed. But if you take a lot of those companies and if you take an infrastructure, I won't mention the company's names, but will execution actually happen? They have lots of order books, but execution is still not there. So I think the market's liking this theme at the moment within India, so they say the infrastructure theme or renewable energy, and PSUs are playing a part in that. So they're getting re-rated because they're in the right sector, but also because governance expectations have changed over the years as well.
All right, and I wanted to also touch on the banking sector, because that has been reeling under some bit of a pressure, especially the private banking space. You have seen great returns coming from the PSU banking pack, but private sector banks, especially if you talk about a few names like HDFC Bank, they have been a laggard for the last 12-15 months. What is weighing on the private banking story here, sir?
I think it's that kind of race to the bottom in terms of getting deposits. It's really the NIMs are under pressure. And you really need to get more deposits before you can kind of get your loan growth going. And I think that's where the problem is. Now, some banks have said, we won't go for a race to that and we'll keep more profitability, but then your loan growth slows, right? So the loan growth expectations are being trimmed. NIMs are continuing to be under pressure. So the real, to my mind, what will happen next? And the budget gave us a great example of what we think will happen. I think the governor has really not talked about interest rates coming down, but he's getting more dovish towards that. The government's not borrowing as much in the short term. So it's all bond market friendly. Now come June, we come into the Bloomberg, the JP Morgan index, bond index, that's $30 billion which is coming in. So I can see inflows to India, between bonds, equities and so forth, an FDI, somewhere towards $100 billion this year. And that's a huge amount of inflows to come. And that will push interest rates down, which will help the banks. Now the question is timing. Right. Do you buy it now or do you buy it when the RBI governor reduces rates? And
in your mind, how are the valuations looking for these private banking pack, considering that the inflow will come in, that will ease some of the pressure from the NIMs? Are the valuations attractive enough for investors to invest?
See, I mean, if you say right now, they're probably going to wait for this kind of turn in the interest rate cycle to say, okay, we can now look further forward and NIMs won't be under pressure, but loan growth will pick up. So that's the kind of combination that investors look at. But I'm sure in this, in today's kind of symposium, that you're going to hear lots of people talk about a $10 trillion economy. I was at a recent Kotak institutional investor who talked about 30 trillion by 2047. Now, you've got to have a banking sector which is equally sized for that opportunity. So I think we're just at the beginning of the runway for banks, but you will get those headwinds now and again when interest rates are a little bit higher.
All right, and another sector that I wanted to pick your brains on is the information technology sector. that has come under a fair bit of pressure as well over the course of last year. And a lot of business for these IT companies comes from US and European markets, and because their discretionary spending has not really picked up, the revenue of these company, of Indian IT services company, has taken a hit. But the expectation is that, at least what we are hearing from the Federal Reserve, they might not go for an interest rate cut, maybe over the next couple of policy meets, but they will not raise interest rates from here on, which has improved the sentiment. But as per channel checks, from what you are talking to industry experts, how is the IT story looking right now?
So the story hasn't changed. It's still under pressure. All the discretionary spending you mentioned has not picked up. So the call is, again, go back to interest rates. If you think interest rates are going to fall, which the Federal Reserve, even though they might delay it, I still said they're going to fall this year. Right? Now that could be accelerated by unforeseen circumstances of higher rates for longer, which will get the Fed to act quicker. But that's the call, right? And then the technology sector will pick up. Anyway, the technology sector is doing so well. It's a tailwind now for IT companies. So I think everyone's thinking IT companies have bottomed in terms of their earnings. It could get a little bit worse, but not so much. And therefore, it's the upturn that you're looking for, and it all depends on interest rates.
All right, and as far as the interest rate cuts go, what is your expectation from the Federal Reserve this time around? Do you foresee, because I remember back in December we were talking about a potential rate cut of 100 BPS this year, but that does not seem to be on cards right now. What are your broad expectations?
So expectations have kind of turned very quickly, right? In December we thought by March he could be looking at reducing rates, but now it's looking more like May, June. Right. I think the data is going to be important over the next 2 to 3 months, and I see the data starting to kind of head south very quickly. So therefore, it could be May, June. I'm still going for that 100 to 150 basis points cut by the Federal Reserve.
That's for FY25.
That's for calendar 25.
All right. And do you expect RBI to follow the suit? Do we wait for Federal Reserve to take that first, take that first step towards monetary easing, or do you expect RBI to diverge? Because inflation has been cooling off very nicely for us. The food inflation, that has been a problem certainly, but that had some seasonality effect as well.
Right. I mean, he can, for sure, and he should if he wants to. I suppose the dilemma would be your currency in the very short term. Would you want it to depreciate so quickly if you're going against everyone holding rates higher? I think maybe after the bond inclusion, where inflows will come, maybe that's the time you can also reduce rates. So it will be slightly after the Fed, but will coincide with the bond inclusion, where you're going to get flows coming in very quickly.
Right. Also wanted to talk to you about the infrastructure that the Indian market regulator has facilitated for us. We are moving towards we are already at the T+1 settlement cycle. The idea is to get to instantaneous settlement, and that's in the pipeline for the next year. Massive strides India is making as far as fintech in this space is concerned, sir.
Yeah, it's been enormous, hasn't it? I mean, from the number of new people coming into the markets is technology just afforded that and given people the opportunity. You don't have to have a Bloomberg or a Reuters. You can look on your phone now and track your shares, and it's brought a lot of people into the market. And also, with the technology in terms of, there's a lot of companies out there. If I put some money to, they'll actually kind of work out where my money should go depending on my risk parameters. Again, it's very quick, and I think investors are liking this more and more. And obviously, the market did well last year, and that helps. But I think that the SIP type saving, $2 billion a month, I think has shown where India, can go to. And don't forget, it's only 4% of household savings is towards equities at the moment, so it's a long way to go.
And you rightly pointed out, India as a market, our people have not been investing as much, but we saw that shift come in post-COVID, where more and more people started opening, investing in markets. And in fact, I was reading one report which pretty much pointed out that 20 lakh Indians are getting into Indian markets each month. And we are talking about India's story. We are talking about betting on India. How long this story do you think is going to last?
the India story.
Yeah.
I think we're still at the very beginning. I mean, it's you know, you go through decades of, you know, when I first came in, you know, kind of late 90s. You know, you had the part of the tech boom, you know, which happened. Then we had the, you know, kind of downturn when the market went down to a P of 8. And then you had that whole run up to 2008, right? And then you had a decade of moving kind of virtually not sideways, but a little bit further up. And now we're seeing all the benefits of the reform process, which have happened over the last, you know, 10 years, whether that's the bankruptcy laws, real estate regulations, all have helped. Even demonetization helped in the end in terms of moving more from cash towards, that really helped the digital kind of wallets as well. So these kind of things, I think, you know, take time to start playing through to the economy. And that's really what we've seen and what we'll continue to see. So the missing leg for my part for India is private capex.
Right.
And once that starts to pick up, then I think you'll see a multiplier effect across many different industries. And I think that we can't, it's hard to do that touch and feel, but all these different highways and rails being open, it opens up new kind of towns and cities, which you don't necessarily kind of put on your radar, but it all helps to build up the economy.
Do you think the private sector is waiting for the elections to get over before they start pumping in the money?
I think some are. You know, there's always that kind of let's just wait and see. But I think a lot of them are now starting to say we have to put capex down, because when you're running at full capacity of, you know, over 75%, then if you're seeing growth in your industry, you've got to start putting down some capacity. So I expect that to happen.
All right, thank you, Mr. Holland. Appreciate your time, appreciate your thoughts.